Right then, you're a small business owner. You're brilliant, you're busy, and you're trying to figure out your finances. You pull up your profit and loss statement and look at that, a healthy profit last month. Time to pop the champagne, surely. But then you glance at your bank account and the numbers aren't even close. The cash just isn't there. It's that sinking, baffling feeling, isn't it? You start wondering, hang on, where did the money actually go? Have I messed this up completely? You haven't. This is the classic textbook gap
I just don't get where all these numbers are coming from.
between what your business has earned on paper and the actual cash you have in the bank. And the key to solving this mystery, to finally connecting the dots between your reports and your real-world balance, is something called accrual accounting. In this video, we're going to sort accrual accounting out once and for all. We'll take you from the absolute basics to seeing how it works in the real world. We're going to turn that confusion into a proper light bulb moment, giving you the confidence to finally understand what's truly going on with your business's health. That feeling of seeing a profitable month on paper while your bank account looks a bit sad and empty is the very problem accrual accounting was invented to solve. So, how does it happen? Well, it all starts with the way we normally think about money. Most of us, and loads of new businesses, run on what's called the cash method. It's simple, it's instinctive, and you're probably using it for your personal finances without a second thought. Cash accounting is exactly what it sounds like. You record money when it comes in, and you record expenses when the money goes out. Simple. If a client pays you for a big job on the 5th of May, that's May income. If you pay your rent on April 30th, that's an April expense. It's a direct look at your cash flow, which is great, but it doesn't tell the full story. In fact, it can give you a picture of your business that's all wobbly, like a funhouse mirror. Your profit can swing wildly based purely on when people decide to pay you, not on the actual work you're doing. And trying to budget or plan with that kind of data is an absolute nightmare. So, to get a true, stable picture of your business's health, you need to switch to the method the professionals use: accrual accounting. There's a reason that financial statements meant to comply with Generally Accepted Accounting Principles, or GAAP, must use it. It provides a far more honest look at your performance. So, what is it then? At its heart, accrual accounting separates the doing of the business from the moving of the cash. Instead of recording revenue when you get paid, you record it when you've earned it. Instead of recording an expense when you pay for something, you record it when you've incurred it, when you actually receive the goods or services. Think of it like this. Say you're a consultant and you finish a project for a client in March. You've earned that money in March. It doesn't matter if they pay you in April, May, or whenever they get around to it. Under accrual accounting, that income belongs to March. Same for expenses. If you use electricity to run your office in March, that's a March expense, even if the bill doesn't arrive until April. This one simple shift in timing is the secret to understanding your business's real profit in any given month. This whole system hinges on two main principles. Get these, and you've got accrual accounting cracked. First up is the revenue recognition principle. This just says that revenue should be recorded in the period you earn it, not when the cash finally shows up. Let's make it real. Imagine you're a graphic designer. In January, a client hires you for a £5,000 branding package. You spend all of January designing logos and choosing color palettes. On January 31st, you deliver the final files. You've done your bit. You have earned the £5,000. You send the invoice and the client pays on February 15th. With the cash method, your January looks like a total bust, zero revenue. But with the accrual method, thanks to this principle, you record the full £5,000 of revenue in January, because that's when you did the work. That's when the value was created. The second big idea is the matching principle. This one's just as important. It says that your expenses should be matched to the revenue they helped you earn and recorded in the same period. This stops those mad profit swings we talked about. Let's go back to our designer. To finish that £5,000 project in January, let's say you bought a special bit of software for £300. You also hired a freelance copywriter for £500, who you've promised to pay next month. The matching principle insists that you record those expenses in January, right alongside the £5,000 of revenue they helped create. So the £300 in software and the £500 in copywriting fees are January expenses, even if the copywriter gets paid in February. Now, your January books show £5,000 in revenue and £800 in expenses for a true profit of £4,200. That is a proper, accurate picture of your work that month. You're matching the effort with the reward. Let's walk through a quick business scenario to see just how different this is. Imagine you run a small manufacturing business. In December, you land a big order. You spend £10,000 on raw materials, which are delivered in December. Your supplier gives you 30 days to pay, so the cash won't leave your account until January. You make the goods and ship the finished products, worth £25,000, to your customer on December 20th. You also give them 30-day terms, so you won't see their payment until January. Now, let's look at December. Under the cash method, what happened? Well, no cash came in, no cash went out. According to your books, revenue was 0, expenses were 0, profit was 0. It looks like you spent the month on holiday. Now, let's look at it the pro way, with the accrual method. Revenue. You earned that £25,000 in December when you shipped the product, so you record £25,000 in revenue. That money your customer owes you is now an asset called accounts receivable. It's an IOU to your business.
Well, that's a nice surprise.
Expenses. You incurred the £10,000 cost for materials in December when they arrived, so you record a £10,000 expense. That money you owe your supplier is a liability called accounts payable. It's a bill you know you have to pay. Under the accrual method, your December financials show £25,000 in revenue, £10,000 in expenses, and a true profit of £15,000. This view is infinitely more useful. It shows you were incredibly productive and profitable in December, which helps you make much smarter decisions. You know you have profits you can work with even while you're waiting for the cash to come in and go out. You're no longer flying completely blind. And that is the light bulb moment. The gap you felt at the start, the healthy profit report and the sad-looking bank account, is perfectly explained. The profit was real. It was just sitting in your accounts receivable. The expenses were real too, perhaps waiting in accounts payable. So why bother with the extra admin? True profitability. It gives you an honest, accurate picture of your financial health. You can see if a product, a service, or even a particular month was actually a success. Better decisions. When you know your real numbers, you can budget properly, manage your resources, and make smart decisions about hiring, expanding, or launching something new. It's required for growth. As your business gets bigger, this becomes non-negotiable. Professional investors and banks will typically insist on accrual-based financial statements because they show a more reliable picture of long-term health. Also, once your business gets to a certain size, we're talking average revenues north of about $30 million in the US, with figures indexed for inflation, the tax authorities will generally require you to use the accrual method for tax purposes, though rules vary based on your business structure. The old rule that holding any inventory automatically forced you into accrual accounting has also been relaxed for many smaller businesses. In short, It's the language of serious business. Adopting accrual accounting isn't just a bookkeeping tweak, it's about adopting a professional, forward-looking view of your business. So, let's go back to that initial frustration, the numbers that just didn't add up. Now you know why. It wasn't a mistake you made, it was just one way of looking at the figures, the cash method. By getting your head around the revenue recognition and matching principles, you now understand the core of accrual accounting. You know that revenue is recorded when it's earned and expenses are recorded when they happen. This simple but powerful shift gives you the clarity to see the true story of your business. You've gone from being baffled by the numbers to being in control of them. If this guide helped clear things up and gave you that light bulb moment we were aiming for, do me a favor and hit that like button. And for more no-nonsense guides to help you master your business, make sure you subscribe. Thanks for watching.